More signs in the U.S. that the inflation is coming down, but at a slower pace than expected. And consumer prices also climbed monthly on elevated rent and energy prices. Now, the mixed index raises the prospect of more aggressive rate hikes to come. Our Kyung-eun starts us off.
U.S. consumer prices in the first month of 2023 increased by 6.4% compared to the same period last year. It marks the seventh consecutive month their year-on-year slowdown has been reported and is well below a recent peak of 9.1% in June. But the latest data from the Labor Department shows that prices are not going down as quickly as expected. Inflation in January is only a 0.1 percentage point down from the 6.5% recorded in December. Watchers from Dow Jones and Wall Street have been looking for 6.2%. Adding to the disappointment is monthly inflation. Prices in January increased 0.5% from December, the most in 3 months, and far higher than December's 0.1% figure. Annual core inflation, which strips out volatile food and energy prices, jumped 5.6% on year and 0.4% on month. Rising housing rental costs accounted for over half of the monthly increase at 0.7% compared to December. Energy was also a significant contributor, with the seemingly stabilizing prices once again rising 2% on month. Following the hotter-than-expected inflation news, U.S. stocks fluctuated, adding pressure amid the prospect of further rate hikes, which are now at their highest levels since September 2007.
And I don't think that the numbers indicated that inflation is completely behind us, meaning they were a little bit maybe elevated relative to what some of the expectations were. So my outlook is sort of one of stagflation, and I think that is going to make it tough for the Fed and for investors.
President Biden, in the meantime, hailed the 7 months of declining yearly inflation, but said there's more work to do in the fight against high prices. Kyung-eun, Arirang News.